Well, welcome to today's FS Club webinar. I was about to say seminar. I guess I'm desperate to get out. What I'd like to do is to welcome one of our great regulars, Dr. David Doyle. Many of you will know David, and it is a pleasure to bring him back, but on such a particularly interesting day, the day after the United Kingdom has decided that it has a different way of negotiating international treaties. David is going to be talking about regulation and recovery, EU financial services in the wake of COVID-19. And there are a lot of interesting trends out there, as I think we all know. And in the midst of all of this, the euro is appreciating against the dollar and other currencies. So there's a lot going on out there that David is going to inform and enlighten us about. As you know, we don't introduce our guests, not because we're rude, but because you've read it all already, and it's online if you want to refresh your memory. But I would like to refresh your memory about our sponsors. We are only able to provide this wide range of topics covering technology, economics, finance, and today a little bit of politics, I suspect, because our sponsors are so kind, generous, and may I use the word tolerant, allowing us to explore these subject areas. As ever, the idea is to get some conversation going. And to do so, we're going to obviously restrict David, sadly, who speaks eloquently on many topics, to hopefully about 20, 25 minutes, and save at least 15 minutes for questions and comments and suggestions from you in the audience. To do so, please do use the GoToWebinar question facility on your screen. No point in emailing me or David for that matter. We're here on the webinar with you. So please send it through that way. And I will feed your comments and questions and suggestions into the discussion that I have with David after his presentation. And I guess really my best job is to get out of your way so David can say what he would like to say. David, the floor is yours.
Thank you, Michael, and good morning, ladies and gentlemen. Welcome to this webinar, where I'm going to be touching on, as I do every 6 months for the Financial Services Club, what's going on in Brussels in terms of the regulatory agenda and the politics associated with this going forward. So let's go to the first slide. In about 4 hours' time, the board of the European Central Bank will be convening. The major agenda item will be how to address the problem and the challenge posed by the hike in the euro vis-a-vis a basket of other currencies, notably the US dollar. The euro has excelled vis-a-vis the US dollar by about 14, 16% in the last couple of months. And this poses a particular challenge for the EU, in that it makes exports from the EU and the Eurozone in particular less competitive, although it might diminish the cost of imports at a time when the Eurozone and Europe in general, mainland Europe, is looking for ways to reignite and reaccelerate the economic growth factor, exports, reduce import vulnerability factors, and so on. This has become a major issue. Interestingly, somewhat perversely perhaps, this rise in the euro vis-a-vis particularly the US dollar is perhaps an indication of the financial markets' confidence in the prospects of the Eurozone in terms of economic growth going forward, and perhaps also an endorsement of and a vote of confidence in the EU recovery package, which was approved in July of this year. So let's move to this particular critical core subject before we go any further. In July of this year, on the back of the European Commission's proposals, something like 750 billion euros of a recovery fund was agreed upon by the Council members. It's currently going through some very agonizing and difficult discussions at the European Parliament level, who want to see certain adjustments being made and further conditionalities being imposed on recipient countries. But this particular package is designed quite visibly to reactivate the European economy, not just in the Eurozone, but across the 27 new member states, to finance solvency, strategic investments via businesses, workers, and sovereign states itself. If all goes well and the agreement can be reached in the next couple of months, the whole of this 750 billion plan and fund will be implemented on the 1st of January next year. The constituent parts of this, probably the most important parts, after much debate, I might add, at the Council, where the Commission started off by asking for 500 billion euros for grants and something like 250 billion euros in loans. The final agreement was 390 billion in terms of grants and 360 billion in terms of loans. The big issue, I think, was probably from the so-called FUCL 4 sovereign states, the Netherlands, Sweden, Austria, and Finland, who did not want to provide funding primarily in the form of grants, but wanted to come in the form of loans, even if it comes with very positive and constructive conditions. Now, the recovery plan will come in two major parts, two major pillars. One is the recovery and resilience facility, in terms of grants and loans. National states will be asked to draw up from the beginning of next year a national recovery and resilience plan, which will have to lay out in great detail how they intend to spend this money, whether it be in terms of propping up existing businesses, providing healthcare, or strengthening healthcare entities and infrastructures, employment subsidies, youth employment, short-term work schemes, and liquidity and solvency measures for the critical areas of the SME constituency. This will come with certain conditionalities. It will mean that member states will indeed have to provide very detailed plans. That it provides, in particular, funding to prop up state aid, as it were, to prop up existing businesses which have been failing. The other big issue, of course, is with something like 40 million European people and citizens unemployed, or at least receiving some form of temporary social welfare and support. Clearly, that's going to be a big issue going forward. The other big issue, and the big focus of this whole recovery plan, is its emphasis on the so-called green and sustainability factor. Something like 25%, perhaps even growing to 30% of the 750 billion will be devoted and directed and focused at sustainable and green type projects. In other words, in the longer term, we can see the encouraging development in renewables, energy efficiency, electrical vehicles, infrastructure related to mobility and transport, to mention but a few. But that's going to be, I think, the focus running through all of this particular program. In terms of the other pillar, the solvency support instrument, there was an original view that we should look at injecting equity into companies across all sectors, and that sadly was not attained in the final shot, as it were, at council level. I guess most member states, in spite of the attractions of propping up and taking equity stakes in strategic industries, there was a sense that this smacked of the old 1950s, 60s type nationalization policies that were pursued by many member states even before the EC was created. and there was little appetite to going back to this particular orthodoxy, which was not seen as being the most suboptimal. The EU budget will also be propped up with a guarantee from the European Investment Bank to mobilize private capital. This is via financial intermediaries such as independently managed funds and special purpose vehicles. And this is where, the role of non-banks will become pretty prominent as I see it. And this is why the Commission is treading a very, very balanced line between ensuring that the non-banking sector, and even including some of the shadow banking sector, which now represents 36% of all financial transactions in Europe, it treads the line between ensuring that the funds and bonds in particular held by the fund managers are liquid, that they're sustainable, that they have the right maturity matching profiles. But that's certainly on one side. Whereas they're also concerned about ensuring a massive engagement, active engagement by the non-financial services sector in contributing to this particular aspect of the support instrument. And over and above that, there will be a strategic investment facility. This is very politically charged, and the issue I think we've realized since the pandemic is that the degree to which we have become over-dependent in Europe on foreign supply chains, particularly in the field of healthcare. Something like 90%, according to the EU statistics, 90% of Europe's pharmaceutical and health products, medical products per se, are actually produced in non-EU member states, where a prominent amount actually made in China and in India. But this is not just about healthcare. Issues have been raised at council level about IT, digital transition. To what extent should Europe continue to be heavily reliant on third country hubs and supply chains as well, when in fact we could be doing a lot of this ourselves? And indeed, as we speak, although it's gone rather silent, just before the summer, there was an initiative going through the Brussels with a view to coming up with guidelines, legally binding guidelines, which would ensure that member states actually assess the degree to which third country corporates are providing critical strategic products and services in that particular member state, which could be to the detriment should there be another pandemic or another crisis. Last point, there would be EU budget guarantees to finance investment projects, again, this via the European Investment Bank and national banks. So in other words, all of the financial services industry will be involved in this. National banks as the vehicles for disposing of these of this 750 billion euros, but also the private equity, asset managers, fund managers as well. The other, I think, important strategic issue here is, for the first time ever, and this represents a mutualization of the cost of the COVID-19 pandemic at EU level, is the notion of the EU going beyond national contributions by member states to fund its activities, to the degree of raising funds in the capital markets repayable over the next 28, 29 years. This is a major shift in terms of mutualization of the cost, but also it is introducing a form of fiscal risk sharing and central debt issuance, which has never been done before in Europe. It also boosts the whole notion and capacity for counter-cyclical policy going forward. The other, perhaps, other really controversial issue is the notion of introducing a tax on big multinational companies who operate in Europe. There's talk about a digital tax, which would kick in sometime over the next 2 or 3 years, plastics tax, which actually will kick in 2021, and a carbon border tax on all non-EU member states that potentially could be introduced in 2023. And the old, highly controversial evil-sounding financial transaction tax, which was so controversial across Europe. There's talk about introducing that, reviving it and introducing it in 2024. This will all fit alongside the EU multi-annual financial framework. This is the 7-year plan, which is worth 1.1 trillion euros at the moment. There is some discussions still going on in terms of how much of this will go towards targeted recovery and support of the EU economy. Now, in the longer term, clearly, as I've said, there's a big shift towards green and sustainability focused of industry, SME support, given that SMEs are so vital to the European economy. But the other issue that's going to have to be addressed in all this, given the big emphasis on sustainability and climate change mitigation and adaptation, and dealing with and addressing environmentally damaging sectors of industry, is the whole stranded asset question. The IMF earlier this year estimated that worldwide stranded assets in fossil fuels, oil or coal and so on, could represent as high as 12 trillion US dollars. And clearly at some stage this is going to have to be addressed. Now, the next issue going forward, of course, the other big issue on the agenda, the double whammy, as it were, is the Brexit issue. As we speak, as you probably know, there are attempts by the UK to reopen the withdrawal agreement. Clearly, after a period of nearly 4.5 decades of following EU regulation, all this is being thrown up in the air, and we're now facing huge questions about the future shape of state aid, which seems to be one of the key issues blocking any future agreement in terms of the trade deal that's going on. Just to remind you, in terms of financial services, the City of London, of course, plays a huge role. There are two major issues that have to be addressed for the financial services industry. One, is there going to be a prospect of an equivalency decision, particularly vis-a-vis investment firms, who in 2021, June 2021, will face a new investment firm regime, which will mean that they will have to start applying 30 billion euros of consolidated assets for a banking license, which will bring them into the ECB as its scope of supervision, but more importantly, the future access to the single market, particularly for wholesale markets, that is to say eligible counterparties and professional investors, could be held up from January the 1st of next year on till a future date, because there isn't an equivalency decision yet provided by the EU. The other big issue is the back-to-back transactions and bookings in particular in the UK, vis-a-vis all financial services activities, and particularly for banking. The general theme running through the messaging and the narrative coming from Brussels and Frankfurt is, it's very clear for all financial institutions based in third country jurisdictions, any financial services activities related to products and clients in the EU should be managed and controlled from a location in the EU. So it's very clear. So let's just look at some of the current issues. Well, clearly, the Brussels narrative is one of the UK is perceived as pursuing a progressive strategy to diverge vis-a-vis the EU rules in financial services. And this will include issues like MEP-EU, it will include PRIPS, it will include the SDGR, it will include a range of financial regulation and directives, which the UK had contributed to and had applied, which includes the forthcoming CRD5. But this is not just about financial services. There are concerns about divergences in environmental, employment, and state aid. The EU revised equivalency assessment has been now revisited yet again in the light of the stalemate in terms of negotiations. And again, we don't seem to have any EU equivalency decision outside of a temporary equivalency decision to allow UK clearinghouses beyond 2020, the end of 2020, for a limited period to allow European Union counterparties to continue using UK CCPs. But outside of that, we've got nothing that we can actually hang onto going forward beyond the end of this year. But therefore, the Commission has reassessed the whole equivalency assessment regime to be built around a forward-looking model. That is to say, the growing concern of the interconnectedness with the UK and ensuring protection of financial stability, investor protection vis-a-vis the EU. The EU equivalency regime still remains, in terms of EU legal instruments, the only way forward and the only gig in town, as it were. But there are large areas of the equivalency regime which are not covered, notably bank lending and deposit taking. There are some areas which are covered, happily, like derivatives clearing under EMIR, trading and transparency on securities financing transactions, and reuse. But there's a big, big question mark around to what extent the UK will follow the existing EU regulatory framework, but both in terms of banking, asset management, fund management, going forward. Quite visibly, this is a sticking point going forward, and we don't have much time to settle some of these issues before the end of the year. And of course, we've missed the deadline in terms of the UK-EU respective equivalence assessments, which are due to be done and complete by the end of June of this year. So therefore, there's a lot of very concerned faces in Brussels and in Frankfurt about where all this is going, and this is why we talk about where is it going, Quavadis. Next slide. We are looking at what has happened in terms of the EU equivalency regime, but parallel to all this, the EU is minded to address some other important issues, notably how can we encourage more use of the capital markets union, in other words, the non-banking sector, in terms of refinancing the economy, reboosting and getting it back on par. And one of the more interesting and perhaps the big game changer, in my view, is the quick fixes that have been introduced and are awaiting ratification by the Council and the European Parliament. It looks actually rather good in terms of some quick fixes that need to be taken that cannot wait until the more in-depth MiFID comprehensive review. A couple of issues that I think need to be flagged. One, there's talk about phasing out paper-based, as it were, communications and replacing it with electronic investor communications, with retail investors nevertheless being allowed to opt in if they so wish. In other words, if they wish to continue to receive paper-based communications from financial institutions, they can do so. But clearly, big relief for the wholesale investors. Exemption from cost and charges disclosures for the wholesale investors in relation to ancillary services, cost of advice and financial instruments. But it won't cover investment advice and portfolio management, nor will it cover retail investments. But nevertheless, the Commission is looking, on the back, by the way, of ESMA advice, to reducing both the, not just the frequency, but exempting whole swaths of the wholesale investors market from cost and charges disclosures. Distance communications, which is already taking a prominent role in terms of investor relations vis-a-vis investing companies. The option is there for all investors to opt in, as it were, for ex-post delivery cost disclosures and charges if they wish to do so. Without the big issue that came out of consultation was the speed with which financial institutions, as it were, acted on the instructions of investors. Periodic loss reports, which are triggered normally when there's a 10% loss, will be disapplied for the wholesale investors with an opt-in if they so wish, but retained for retail clients on a biannual rather than a quarterly basis. And of course, the other big game changer, a big surprise to us all, was the suspension of the so-called best execution reports under MIFIR, which will be suspended should this whole package go through from the beginning of January next year, pending a 2022 full MiFID assessment of the value of these reports going forward. Some more flexibility is being built into expanding the list of non-complex products in MiFID They seem to be very targeted here in looking at allowing, for instance, some simple corporate bonds with make-whole clauses, which provide some degree of protection, being included in the list of non-complex products going forward. And of course, the other controversial issue, removing the unbundling rules for research vis-à-vis trading commissions for small and mid-cap issuers, which was deeply unpopular in mainland Europe, particularly amongst the French and the Germans going forward. My view is a lot of this will probably go through. It's all focused on COVID-19 measures, as it were, to help develop and activate the capital markets in Europe. Next slide. There is, however, other problems, structural problems lurking in the fund management sector, which has got enormous attention since the COVID crisis, from the IMF, from the World Bank, from the OECD, from the European Commission, from ESMA, from the ESRB, that is to say the European Systematic Risk Board in Europe, which has been handing down a lot of warnings to ESMA, the national competent authorities, about the degree of their concern of market illiquidity in the fund management space. They talk specifically about investment funds with significant exposures to corporate debt. And I would remind you here that something like 40% of all debt owed by companies to investors, it was seen as being vulnerable in the EU, according to statistics produced by IMF and confirmed by ESMA. In the real estate market, understandably, predictably, with the drop in transactions, this has had a negative effect on real estate funds, which are currently, according to statistics, it represents something like 39% of all investments held by fund managers. And the concern here is that in both corporate debt and in terms of real estate funds of funds, for instance, we could be looking at some very key vulnerability factors, which is why, not surprisingly, ESMA this month recommended that, and was backed by the Commission, that all fund managers, small, large, medium-sized, introduce a liquidity stress test at least every 2 years. Next slide. Going forward, we are also looking at the other big elephant in the room, the sustainability, financial sustainability focused agenda. Probably the most important of these four pillars is the disclosure regulation per se, which should apply from March 2021 and would affect all asset managers and fund managers in particular, and banks as well, in terms of sustainability investment, as to whether the funds either contribute or do no harm in terms of ESG criteria, and whether sustainability risks have been identified by these funds, and whether ESG events could and have impacted negatively the asset values, and sustainability factors like human rights, anti-corruption, AML compliance are highlighted as being very important. Now, as we speak, there's been a lot of pressure coming from all over Europe to force the Commission to actually delay the implementation of this disclosure regulation. Many asset managers and fund managers believe they're not ready to deal with this. So potentially, I think we could be heading for a 6-month, maybe an 8-month delay here going forward. The other factor I would mention is we, in theory, should have the, not so much an introduction, but certainly a draft piece of legislation on an eco-label for all financial products ready by the third quarter of 2021. So this is looking forward. There's also, importantly, integration of sustainability factors into all of the existing legislation at EU level, UCITS, AIFMD, MiFID II, Solvency II, and the Insurance Distribution Directive, which introduces via delegated acts It's already happened in June of this year. A number of requirements in terms of organizational and operational conditions, risk management policy, and product governance. Product governance being a critical issue going forward. So, on that note, let me conclude in the next slide by saying quite visibly the two big whammies at the moment affecting and certainly influencing EU policy is Brexit, clearly, and as I've said already, the immediate question is what happens to third country investment firms servicing notably the wholesale markets from January the 1st of next year. What are they going to do in the absence of a equivalency decision? They're going to have to quite visibly start negotiating individually with each of the national competent authorities, of course, the 27 EU member states, for a separate license. Now, retail investors, of course, are treated differently under MiFID and MiFIR. You have to set up a local branch in the jurisdiction you wish to sell to those retail clients, which can also be quite burdensome. Of course, there's reverse solicitation, which could be used, but is actually very restrained under the recent provisions. So that's the first issue. And the second issue, obviously, is the degree to which the financial services industry will engage at all levels in terms of the 750 billion recovery fund in acting as a vehicle and acting as a goalpost, as it were, for entry into the market. And bearing in mind, of course, the important dimension, 25% of that budget or that particular fund will be devoted exclusively to the green and sustainability investment agenda going forward. Michael, on those notes,
Great.
Let me fall back to you. Thank you.
David, a masterful survey of a very complex situation and why we love having you come and sharing these little nuggets from Paris. Lots of questions, so we're going to have to move quickly if you don't mind. I'll start with the first one, a small critique. Bob McDowell wonders if your analysis of the strength of the euro versus other currencies is short-term, a little fanciful given the political tumult of the currency markets. So how enduring do you think it is?
Yeah. I don't think it's sustainable in the long term. The US dollar has a major advantage in that it's a unique currency in a very large region. It's also a massively important reserve currency, which the euro isn't. And I think that once the US gets back on its track, as it were, and perhaps revisits the Fed's policy on advanced inflation, as it were, advice, maybe the dollar will regain on the FX markets. For the euro, well, frankly, today I don't think we can expect any major decisions. I could be wrong, but I don't expect Christine Lagarde to herald in a further expansion of the emergency bond buying program. I don't think that that's on the cards, nor do I see them having much appetite or indeed even room to lower the interest rates any further. Don't forget, the interest rates are already in zero territory. Every 0.1% of an interest rate drop swipes 2 trillion euros off the European banks' balance sheets. So I don't think that's on the cards. I think they'll continue, the ECB will continue to make statements to try and talk down the value of the euro, but beyond that, I don't see any other measures being taken.
Liz Russell's curious, all this new funding, new forms of funding, of course, the taxation. Liz Russell's curious, how does this align and perhaps change the ECB's role?
The ECB's role of this is not really strategically critical, as it were. This is more of an EU-related issue. In other words, all of the new sources of finance that I mentioned, including the controversial financial transactions tax, the cross-border carbon tax, the digital tax, All of this has to be, as it were, reviewed and ratified by the Council of 27 EU member states, and also, by the way, the European Parliament. So, the ECB will not be involved. They may express their views about this one way or the other, but they won't have as it were, a legal opinion to put forward in terms of these new sources of finance.
It's interesting. Taxes. Stephen Murgatroyd is asking regarding the proposed digital tax. What is the U.S. response? But personally, I can also see here, for example, the carbon border tax, FTT, and the large corporation tax equally. Have there been any early indications of response? A sort of a little rumbling that it might not be
acceptable,
comfortable.
Yeah. I mean, certainly the US has never concealed its view concerning the digital tax. And some member states have been at the tipping point of introducing it at a national level before the OECD has had time to review a number of options which could be adopted by the EU and the US. So yes, I mean, the US is visibly unhappy about this. They've made this publicly clear. There are a number of other non-EU member states that are spooked about particularly the cross-border carbon tax. This hits, a range of issues, fuel and energy-related issues that is going to affect the likes of Australia, South Korea, China, and others. So quite visibly, this is going to have to be balanced when it comes to discussing the introduction of these new taxes to fund the recovery program going forward.
David, there's unprecedented change going on in the EU, as everywhere else it appears. And you referred to the Frugal Four, the Netherlands, Sweden, Austria, and Finland. That's one block pulling away. We've obviously got the North-South divide. We've got the East-West divides. We've got the Brexit Channel divide. So there's a lot going on that was separating the EU. And yet a lot of these initiatives, many people claim, will unite it. Charles Vermont's curious, do you believe the EU will still exist in its current form in 20 years' time? I mean, is this scale of change moving us to a new form of the EU, whatever it is?
Yeah. I mean, there are two things that are happening. One, I think a realization that there needs to be more consultation further down the food chain, at civil society level. And indeed, by the way, this whole package, the 750 billion recovery plan, will still have to be subject to endorsement by national parliaments in the 27 EU member states. So that's already an indication of, the change in orthodoxy. So that's certainly one. There's a need for greater engagement with civil society, with NGOs, with the financial services sector as well. As I said earlier, the Commission is only too clearly minded of the fact that they need to keep the non-banking financial services sector on board, because they are the gateway to new funding opportunities. And I think the other big issue is tackling the need to tackle the other, the big strategic challenges and threats, by the way. One is the lack of any clarity around illegal immigration into Europe. There's quite a significant divide in this in Europe. And the other one is, as I mentioned already, is the degree to which the European Union has realized that it's very heavily over-reliant on foreign supply chains, particularly in the area of IT, digital services, healthcare, et cetera, et cetera. And those areas are going to get priority going forward. I think there is a general consensus that these need to be addressed. So yes, I don't think the EU is going to disappear overnight. Quite visibly, there are important, difficult negotiations going forward. I think many of the southern EU member states recognize the virtues of access, unfettered access for products, goods, and services across borders in Europe. the Eastern Bloc recognized the importance of funding and technical expertise and institutional capacity building that's provided by the EU to bring them up to the same level as the pre-accession countries. But all of this has to be done in the framework of a collective agreement on this 750 billion recovery fund. So I remain cautiously optimistic that this will go through. This will herald in a new orthodoxy in terms of mutualization of risks, which has hitherto eluded Europe for a variety of reasons. So I think the future, certainly over the next 4 months, will be critical in mapping out the tangible, as it were, and concrete plans going forward.
I'm going to skip a number of questions because I think you've touched on some comments from Hugh, Bob, and some others, but we're running short of time. So I've got just a couple of areas I'd like to cover. One is about the UK-EU relationship. Mark Cook is curious, sort of quickly, is the UK derivatives market still our key to access? Meaning, is that still the UK's key to access?
Is the UK still keen on access?
So is the UK derivatives market
still
the UK's key to access financial services? I assume he's meaning here equivalents in Europe.
Yes, absolutely. It's probably one of the most critical areas of the financial services architecture. And indeed, it's no secret that the Commission decided just before the summer to extend the temporary equivalency regime for CCPs based in the UK, which means that counterparties based in the European Economic Area, that includes the 27 plus Norway, Liechtenstein and Iceland, can continue to clear their derivatives, particularly FX trades and energy trades in the UK. There's no indication as to how long this is going to last, but quite visibly, as I think I made this point on my last webinar with you, Michael, quite visibly, nobody in Europe, in Brussels or Frankfurt, wants a fundamental rupture in the financial flows in Europe. Nobody wants to find themselves, as a result of a sudden cut-off in derivatives, trading, by the way, and clearing, find itself in a situation where they're scrabbling, looking for alternative CCPs elsewhere in Europe. So this is why there's been a very cautious approach taken by the Commission to ensure stability of the financial system via this temporary equivalency regime. But also, let me just mention, while we're speaking about equivalency, I was looking at some statistics this morning. Something like over 50% of Eurozone bond and equity issuances originate in the UK. This is a huge, huge stick, huge interconnectivity factor that I mentioned already. And again, it's not easy to, it's not readily obvious to me that alternative sources can be found both in the trading and in the clearing sector. So clearly, these are the two issues that we need to focus on going forward.
Liz Thrussell points to the state funding, the scale of state funding here, which the EU is pursuing. I guess she's really wondering here, is this hypocritical, given that this is the stumbling block or one of the two stumbling blocks in the UK Brexit negotiations?
Well, actually, what's ironic about this isn't, the fact that the EU has introduced on 2 occasions since COVID-19 temporary state aid rule relaxation measures. But the irony of all this was actually the UK under Thatcher was the one that was the key catalyst within the European Union, or what was then the common market, to actually push for a more rigorous rules-binding system of state aid, as it were, restrictions, which was being used very liberally by many, many states on mainland Europe. So it's a bit ironic in a way. But what's concerning the European Union at the moment, it isn't so much the zombie companies that may be propped up by the state aid, as much as they may, the UK may wish to go further. And when it's now well think, reported in the public domain, about the need to pursue a divergent policy in the UK to make the UK a very attractive inward location for investment. But clearly, some balance has to be found. Maybe an MOU, maybe a revision in the withdrawal agreement every 6 months to make sure that everybody on both sides, I might add, are respecting the rules.
Speaking of divergence, Hugo Innes is curious, do you have any comment on the EU's divergence from the OECD on blacklisting international financial centers, the offshore centers?
Yeah, well, again, in the public domain, the Commission was actually surprised. It did express a surprise at the criteria. Sorry, the other way around, actually. It was the OECD expressed a surprise at the criteria that were being used by the EU late last year in blacklisting whatever it was, 37 non-EU jurisdictions. It believed that, the OECD believed that their criteria were perhaps more robust and fairer. And quite visibly, the EU in the next couple of months will be updating at the request of several council members in Europe, will be updating this blacklist with tougher criteria. This is backed also by the Green MEPs, some of the Socialists, but also, by the way, by some of the centre-right MEPs as well. You might be surprised to find that a lot of the heat on respecting anti-money laundering rules and exchange of information on an automatic basis vis-a-vis third countries is actually coming from some of the centre-right MEPs in the European Parliament. So yes, I think we're going to expect a much more focused and standalone approach by the EU in terms of its future reiteration of this blacklist.
We've run out of time, but I can't resist, and you're in a unique spot at a unique moment. So we're lucky to have you. Paul Dooley led with this, which was he's concerned about announcements from the British government on its intentions to breach the Brexit withdrawal agreement, breaking international law and dramatically undermining trust. If the British government stick to this course, the City of London will for sure lose its footing. I might add to that I've seen this comment quite a bit over the last 36, 48 hours. And there have been, of course, intimations as well that London is a major arbitration mediation center, and that some of this stuff could have some effects. We could go on about this for another webinar without any trouble, but what's the feeling at the moment in Paris? What are people saying about this? Is this just another typical UK ploy? Is this a groundbreaking area? Is it a deal-breaking ploy?
Yeah. Well, it's not so much Paris as much as the whole of the EU, with perhaps the notable exception of the Republic of Ireland, who have very privileged trading relationships with the UK. But the whole of the EU at council level seems to be pretty much of the common view. There's a consensus that there can be no negotiations based on divergence from the critical areas in relation to the four freedoms: freedom of goods, services, people, and capital. And added to that, are issues like respect of environmental, social, employment law, and of course, more recently, the state aid issues as well. So there is, I think, a unified opinion, not just in Paris but elsewhere, that that there needs to be some upfront guarantees from the UK in terms of these particular elements going forward. And this is potentially what's holding up the critical equivalency assessment and decision-making process. Some are even saying that this is probably a ploy being used to coach or encourage the UK to come forward with a compromise before the end of the year. Quite visibly, the financial services industry is right. This is going to be a big issue. The ECB has been warning over the summer banks are still not doing enough to redeploy staff and assets and control and manage their assets from a location in the EU. And they're not kidding. So yes, this, and indeed I think some of the leading trade bodies in the UK have been echoing the concerns that there needs to be a compromise reached fairly quickly, particularly not in relation to all of the 38 pieces of legislation, but issues that are critical that we've mentioned, such as clearing of derivatives, trading, issuance of bonds and equities. All of these take place and are critical in the City of London, where there is a sort of an ecosystem which provides a great combination of expertise that doesn't seem to be replicated elsewhere in Europe. And the fear, I guess, deep down in Europe also is, well, hold on, we don't want to go too far out. Otherwise, we will find a lot of financial transactions and investment not coming into Europe, but going elsewhere beyond Europe to the United States, Singapore, or other non-EU jurisdictions.
Wow. These are very interesting times. I was surprised last night, in fact, in the UK, that the news was very much focused on the reduction to 6 people, and then the second item was in fact this breach of international law, but it merited about 2 or 3 minutes. And I was also surprised at some of the reactions. Ms. von der Leyen, quoting "Pacta sunt servanda," to show how fundamental this attack has been. David, as ever, I mean, we've got some people who want to talk about alternative currencies, digital currencies, the wire card typical, long-term debt, the taking of equity stakes by government. I could go on, but sadly I can't. And I'm getting a number of comments here thanking you for your very kind presentation and very informative. And I'll pass all of those comments and questions on to you, of course, as we do. But sadly, it remains for me to thank 3 groups of people quickly, and you're last. The first is, of course, as I opened, our sponsors. May I say thanks to all of you. I hope you found today's discussion interesting and helpful, and certainly it came at a propitious time. Secondly, all of you watching and commenting and contributing, thanks very much for all the comments. And sorry I can't get around to all of them in a session. We have a really good set of webinars coming forward next week. Looking at patenting, something we often don't look at in financial services, but the nitty-gritty of what it means to get a financial services patent. We're going to be looking at leadership and mindfulness, a rather interesting departure for us. Our FSG anti-money laundering group continues, and it will be looking at the tech side of AML. And very finally, we're going to be looking at how you do employment-related securities, and the complexity is going to be examined by our expert on that subject, David Craddock. So it should be a fascinating week next week. But most importantly, David, I need to thank you. You're a regular here because we regularly love having you. So thank you so much. And as I said, or as you said, my apologies, David's coming back in early January. Traditionally, David opens our year, and he will be opening it next year. The date's already up on the calendar, so you can book it if you want. And if there's something of an emergency nature, I have a sneaking suspicion we'll be calling David to do an emergency webinar, which, given the way that the Brexit negotiations have been going for 4 years, could well be necessary. Anyway, David, as I said before, sadly, in these times of COVID-19, I'm unable to open the gates and let the audience applaud. So I have my Korean karmic clapper, and I will do it myself if you don't mind. Thank you most sincerely for your session today. And
Thank you. Thank you. Thank you.